Welcome back to The Explainer, everyone. Today, we are looking at an absolutely monumental move shaking up both the tech and financial worlds. So Anthropic is gearing up to go public, but here's the catch. They're doing it entirely behind closed doors. We're going to break down the massive financial ripple effects of this decision, look at the hard data, and figure out exactly what this means for the global market. Okay, let's just dive right into it because this is literally the multi-billion-dollar question. Why on earth is the creator of the Claude AI models hiding its financials? Anthropic just submitted a secret filing to the SEC, and honestly, the mystery and the stakes surrounding this document are just incredibly high. This sets the stage for what's going to be one of the most anticipated stock market debuts in recent memory. But they are doing everything in their power to keep those exact numbers under wraps for as long as legally possible. So let's demystify the whole secrecy angle for a second. A confidential IPO filing, what is it? Well, it basically just allows a private company to submit its financials to the SEC totally out of the public eye. And yet, it is a perfectly legal, highly strategic move. It gives them this quiet, private dialogue with regulators, which is absolutely crucial, because it shields their highly sensitive data from competitors before they are finally forced to show their hand to the rest of the world. All right, Section 1, the secret filing. Let's go inside the SEC review. So, how does this pipeline actually work? It starts off simply enough with a draft form S1. That's the document containing all their sensitive revenue figures and business risks. From there, it goes into a private regulatory review, where SEC officials basically put the data under a microscope to ensure compliance and protect future investors. And that sparks a quiet negotiation phase. Anthropic answers questions, they update their disclosures, all without tipping off any of their rivals. Finally, just weeks before the actual stock sale, boom, the documents are revealed to the public. That's when investment banks sweep in to evaluate investor demand, scrutinize that annual revenue run rate, and set that all-important starting stock price. Moving on to Section 2, motivation to go public. We're talking about funding the AI revolution. $47 billion. Just let the sheer scale of that sink in for a moment. That is Anthropic's estimated annualized revenue based on their recent monthly performance. That figure right there, that's the engine driving their sky-high financial value. It's undeniable proof that there is immense, tangible demand for exactly what they are building. And, that massive revenue leads directly to an absolutely staggering benchmark valuation, $965 billion. We are talking about a near $1 trillion pre-IPO valuation, which was set during their final private funding rounds. When you're dealing with numbers that have this much sheer gravity, corporate leaders are basically forced to make the leap from a privately held company to a publicly traded powerhouse. And this right here illustrates exactly why they have to make that leap. Private venture capital, it's ultimately pretty constrained. Corporate leaders have figured out that private VC funds simply cannot sustain these multi-billion-dollar infrastructure costs over the long haul. Public market capital, on the other hand, unlocks access to literally billions of dollars from stock market investors. And they absolutely need that war chest to pay for massive compute, extreme energy demands, and, of course, endless microchips. The reality is, the AI infrastructure race has fundamentally outgrown traditional venture capital. But here's a really fascinating twist to all this aggressive financial scaling. Anthropic actually operates as a public benefit corporation, or a PBC. That means their corporate structure legally mandates them to balance public good and safety research against corporate profit. It's a wildly unique dynamic, right? Pushing for a near $1 trillion valuation on Wall Street while literally carrying a legal requirement to prioritize AI safety. Which brings us to Section 3, the ripple effects. Let's look at the shockwaves this is sending across the tech world. Think of this single confidential filing like a massive boulder dropped into a pond. It triggers this immediate cause and effect reaction across the whole industry. First off, you're going to see a sudden shift in valuation standards. Analysts are basically going to stop valuing the AI sector based purely on future potential, and they'll start demanding strict multipliers of actual real-world revenue and operating profit. Naturally, that accelerates timelines for competitors, like OpenAI, for example, who now have to speed up their own public listing plans just so they don't lose Wall Street's interest. And finally, it drives a massive hardware demand surge. This immediately boosts the stock prices of the data center and microchip suppliers who are actually powering these gigantic models. Okay, let's ground these big macro concepts for a second. What does this mean in practical reality? Well, for retail and institutional investors, this is basically the very first opportunity to buy direct shares in a pure-play generative AI firm on a public exchange. For enterprise software buyers, it means they can finally look at audited financial records to judge long-term vendor stability before they sign any major contracts. Inside the tech industry itself, worker compensation is going to shift from illiquid private shares to highly liquid public stock options. And for the broader financial markets, well, a listing of this incredible size absorbs so much available investment capital that it actually threatens the trading volume of older, more established tech stocks. And finally, Section 4, Opportunities and Market Risks. Time for the objective reality check? Because, look, despite all the wild market enthusiasm, we have to take a neutral look at the severe challenges ahead here. It starts with incredibly high cash burn rates. We're talking billions spent on data centers before they even generate a single dollar of profit. And public investors might severely penalize them if those costs stay too high. Compound that with market volatility. Once this confidentiality ends, public disclosure of any prior financial losses can trigger sudden, steep drops in market value. Then you've got regulatory bottlenecks. The SEC could totally delay the entire process by demanding changes to how the company actually reports its revenue. And finally, their deep infrastructure dependence means that any hiccup or failure in third-party cloud computing or hardware supply chains directly harms Anthropic's core value. So all of this leads us to one final pressing question. Will the actual revenue match the immense investor hype when the secrecy finally ends? I mean, this listing is designed to validate the entire business model and prove that large-scale AI can actually generate sustainable profit. But if the real financial results fall short of the hype, this reveal could trigger a massive decline in tech stock prices globally. It is a high-stakes reality check, and the entire world is waiting to see what happens. Thank you so much for joining me for this explainer, and definitely keep your eyes on the markets.